Okay, Chapter 13 is about corporations, so we'll be talking about their organization, stock transactions, and dividends. A corporation is a legal entity that is distinct and separate from the individuals who own and operate it. Some advantages of corporations are separate legal existence, so that's kind of what I just said. The owners are separate from the corporation itself. So if you were to sue Facebook, for example, a company, you are not suing every single individual who owns a share in Facebook. You are suing Facebook, the corporation, which has a separate legal existence. Another advantage is continuous life. So using Facebook as that same example, Facebook has existed for many years and will continue to exist for many years despite shareholders turning over. Corporations have the ability to raise large amounts of capital, usually through IPOs or seasoned equity offerings, and they also have limited legal liability, which goes back to that example I just gave about suing. You are suing the corporation, not every single stockholder, and then even if you were, they can only lose their investment, not all of their assets. Some disadvantages of corporations. The first is that the owner is separate from management, and I'll talk about that down below in a second, but basically this leads to what's called agency problems. The second disadvantage is double taxation of dividends, and we talked about this in the tax section. That's where corporations, their earnings are taxed to get down to net income, and then they pay dividends out of their net income. The dividends go to investors who then have to pay taxes on the dividends as investment income. So basically, they are doubly taxed. And then the final disadvantage is regulation. So corporations are subject to more stringent rules and regulation. Corporations issue stock, which are shares of ownership in a corporation. The stockholders technically own the company, and since there's usually so many of them, they elect a board of directors who elect officers such as the CEO, the CFO, all of that, who then run the company on a day-to-day basis. So there's a separation between the owners, the stockholders, and management, the officers, which leads to those agency problems. So, stockholders' equity is owner's equity in a corporation and is generated from two main sources. The first is paid-in capital, so that is capital contributed to the corporation by stockholders. And this occurs mainly through IPOs, but also through what's called seasoned equity offerings. So, in an IPO or initial public offering, that is a company's first issuance of stock to the public. They raise cash and they give out shares, and that is how capital first comes in. A seasoned equity offering is just another issuing of equity after a corporation has already IPO'd. So that's the first main source of owner's equity, paid-in capital. The second is retained earnings. So that is net income retained in the business that has not been distributed as dividends. We know from the closing process in Chapter 4 that net income increases owner's equity and net loss decreases owner's equity. So retained earnings, that increases owner's equity. And then that little bit about dividends right there. Dividends are distributions of a corporation's earnings to stockholders, and we'll talk about those in more detail in a second. But since dividends are a payment, they decrease owner's equity because you pay dividends out of net income. That means less net income is contributing to owner's equity. Okay, characteristics of stock. There are three main categories that we're going to talk about. The first is authorized stock. So that is the number of shares that a corporation is allowed to issue. So that's the total amount they could issue if they wanted to, and that's in their charter. And that's the largest circle you see there because that's the total amount they could possibly issue if they wanted to. Issued stock is shares issued to stockholders and owned by them. It's any share that has ever been issued It's smaller than authorized stock because usually corporations don't issue all of the stock they're authorized to issue. And then outstanding stock is stock currently in the hands of stockholders. So that's the most important phrase, currently in the hands of stockholders. And as you see, there's a difference in the size of the rings here between issued and outstanding. That is because corporations may reacquire some stock that has been issued, and we'll talk about that later when we talk about treasury stock. So the difference between issued and outstanding is what's called treasury stock. So that's stock that has been reacquired. So it was issued, and at one point it was in the hands of stockholders, but then the company bought it back. So it had been issued, but it's no longer in the hands of the public. So that's the difference between those two categories. And then par value is the dollar value assigned to each stock, which will be very important for journalizing, but it's not really important in practice. Okay, classes of stock. When only one class of stock is issued, it's called common stock. And each share of common stock has equal rights, some of which include the right to vote in matters concerning the corporation, so you can vote if you own common stock, the right to share in the distribution of earnings, so they do get dividends if there's enough funding, and we'll talk about that later, and then the right to share in assets upon liquidation. It's important to note, though, that when a company is liquidating, we pay creditors first, so those are people we owe money to, and there's a whole pecking order, and common stockholders are at the very bottom, so they get whatever's left if there's anything left. A corporation may also issue one or more classes of stock with various preferences called preferred stock. And preferred stockholders have first rights to any dividends, and that's going to be important. So preferred stock, first rights to any dividends. And then we distinguish cumulative preferred stock. So cumulative preferred stock has a right to receive regular dividends. So it has a certain amount that it receives, and then it receives any dividends that were not declared or paid in prior years. So basically what that means is you get a certain amount of dividends every year, and if the corporation doesn't pay you those dividends this year, then the next year that they issue dividends, they owe you those dividends for the years that they didn't pay. Then they owe you dividends in the current year, and then only after all of that can they pay out any dividends to common shareholders. So dividends in arrears are cumulative preferred stock dividends that have not been paid in prior years. And like I just said, they must be paid before common stock dividends are paid. And I'm going to show you an example of that now. So, ABC Company has 20,000 shares of cumulative preferred 1% stock of $100 par and 100,000 shares of $50 par common stock. The following were distributed as dividends. Determine dividends per share. So the first thing that you do is determine how much in dividends the preferred stockholders are owed each year. So, amount owed to preferred stockholders is equal to the number of shares, so 20,000, times the par value per share of 100, times the percent dividend they're paying out, so that's 1%. And if you do that out for this, it's 20,000 times $100 times 1%, that is $20,000 owed every year because it's cumulative preferred stock. So now that we know that, we are going to determine how much in dividends per share are paid to preferred stockholders and common stockholders in each year. So for year one, we are paying out $10,000 in dividends, and we owe preferred shareholders $20,000 in dividends. So automatically, all $10,000 that we're paying out is going to preferred shareholders. So preferred are going to get the full $10,000 paid out in dividends, divided by the number of shares of preferred stock. So that is 20,000 shares. And that is equal to 50 cents per share for preferred. Obviously, we spent all of it on preferred, so that means common stockholders get nothing in year one. So the total values we're looking at for year one, dividends per share for preferred stockholders, it is 50 cents per share, and then for common stockholders, it's $0 per share. And then before we go to year two, we need to check for any dividends in arrears. So we know that we're supposed to pay this $20,000 every year. We only paid out $10,000 this year. So that means dividends in arrears are $20,000 minus $10,000 equals $10,000 owed in year two. So now, going to year two. In year two, we're paying out $45,000 in dividends. So, again, we start with preferred. We owe them $10,000 of dividends in arrears, and then we owe another $20,000 for this year. Because, again, they are paid $20,000 every year, and then we owe them $10,000 from last year. So in total, they're getting $30,000. And we can pay them all out this year because we're paying out $45,000 in dividends. So $30,000 is going to preferred shareholders, and that's divided by, again, the 20,000 shares of preferred stock. So preferred stockholders are getting $150 per share. Now, there is money left over. So common shareholders are going to get the $45,000 minus the $30,000 paid to the preferred shareholders divided by the number of shares of common stock. So that is 100,000 shares. So that is equal to 15 cents per share. And then I'm not going to go through year three with you. You can try that on your own and check in with me later if you want. But because there are no dividends in arrears, you would just simply do the $20,000 owed to the preferred stockholders divided by the number of shares, and the rest of it goes to common stockholders. So that can be an exercise for you guys. Okay. Issuing stock. So stock is often issued at a price other than its par value, because par values are usually, first of all, they're arbitrary. They're usually very small, so they're like 1 cent, $0.0001, like some number like that. If a stock is issued for a price that is more than its par, the stock has been sold at a premium. So if it's at a price more than par, that's at a premium. And then when you issue stock at a premium, you are going to be using this account called paid in capital in excess of par. So the entry will be debit cash, because whenever you're issuing stock, what you're doing is you are raising money from the public. You are getting cash and you are giving them a share of stock in your company in exchange for that cash. So you're debiting cash to increase it. You are crediting common or preferred stock, whichever one or both, depending on what's being issued, for the number of shares times the par value per share, because that is our accounting value for the stock. The number of shares you're issuing times the par value. So you're crediting common or preferred stock, and then you are crediting paid-in capital in excess of par for the share price minus the par value times the number of shares. So it's exactly what it sounds like, paid-in capital in excess of par. So the share price minus what the par value is times the number of shares is your paid-in capital in excess of par. So I'll show you what it looks like on the next slide with examples, but without numbers, it would be debit to cash for the amount you're receiving, a credit to, let's just say common stock for now, common stock for number times par, so the number of shares times the par value per share, and paid in capital in excess of par for share price minus par times number of shares. And cash is for share price times number of shares. And I'll go over this in an example in the next slide, so no worries if it doesn't make sense right now. But that's the basic entry. Cash is debited, common stock is credited because it's an equity account, and then paid in capital in excess of par is credited. If a stock has been issued for a price that is less than its par, the stock has been sold at a discount, but that does not happen often, actually like almost never, because I told you how extremely low the par values are. Okay, so these are two examples. If you were to issue stock at par, it would look like this. Say you were issuing 50,000 shares of $20 common stock and 5,000 shares of $100 preferred. And this value here, this means $20 common stock means $20 par, and $100 preferred means $100 par. So, like I said from above, the first thing we do is debit cash, and we are debiting cash for $1,500,000. And that is the 50,000 shares of common stock at $20 per share, plus 5,000 shares of preferred at $100 per share. So that's what we're receiving in cash because here it's issued at par, so the par value is $20 and the share price is $20. And same for preferred, the par value is $100 and the share price is $100. Common stock is going to be credited for $1 million, and that is just, again, the 50,000 shares times $20 par. And preferred stock is going to be credited for $500,000, and that is the 5,000 shares times $100 par. If it is issued at a premium, then it looks like this. So it's 2,000 shares of $50 preferred stock for cash at $55 per share. So now par and share price are different. So this is share price, and this is par. Cash is debited for share price times number of shares. So this is the $55 share price times 2,000 shares, and we debit cash to increase it because we are receiving cash and giving them stock in exchange. Preferred stock is credited for the par value times the number of shares. So that is $50 times 2,000 shares. And then paid in capital in excess of par is credited for share price minus par value, so 55 minus 50, times number of shares. So that's 55 minus 50 is $5, times 2,000 is $10,000. And paid in capital in excess of par is basically like the extra that you're getting above the par value. So that's, you were selling it for $55 and then its par value is $50, so you get $5 additional dollars per share. So again, issued at a premium, you debit cash, you credit preferred stock, and you credit paid in capital in excess of par. Okay, accounting for dividends. There are two types, cash and stock. A cash dividend is a cash distribution of earnings by a corporation to its shareholders. And there are 3 conditions necessary for a cash dividend. The first is sufficient retained earnings. So if you only have a little bit in retained earnings, you are not paying out a cash dividend. You are instead saving that and accumulating it because you might need it. Second, just because you have sufficient retained earnings doesn't necessarily mean that it's in cash. Maybe you earned a lot of your revenue from credit card sales and a lot of it's still accounts receivable. So you need sufficient retained earnings and you need sufficient cash. And then third, you need a formal action by the board of directors. There are 3 dates relevant to dividends. The first is the date of declaration, and that is the date a dividend is formally authorized and a liability is incurred. So on that date, you have a journal entry, and that journal entry is cash dividends is debited, a little bit of a tongue twister, and then cash dividends payable is credited. So you are incurring a liability on this date. As soon as the board declares it, then it becomes a liability for the company to pay. So you debit cash dividends and you credit cash dividends payable. The date of record determines which stockholders receive the dividend. So if on October 1st it was declared, maybe on like October 25th or something, they say, okay, any person who owns the stock as of October 25th will get the dividend. Anyone who owns it after the 25th will not get the dividend. And they need to specify this because stock changes hands so rapidly that they need to know who they're paying the dividend to and who they're not paying the dividend to. The date of record doesn't have a journal entry associated with it. It just determines who is receiving the dividend. And the third date is date of payment, and that is when the dividend is actually paid to the stockholders. You get rid of the liability and you pay out cash for a cash dividend. So you are debiting cash dividends payable to get rid of the liability because you're paying it, and then you are crediting cash to reflect the fact that you are paying out cash to your shareholders. So that is cash dividends. There's also stock dividends. So a stock dividend is simply a distribution of shares of stock to stockholders. So instead of cash, they get stock. Stock dividends only affect stockholders' equity. So that's quite important. The amount of stock dividend is simply transferred from retained earnings to paid in capital. So unlike with cash dividends, you're not paying out the cash and not getting it back. You are just simply transferring it from retained earnings to paid in capital because now your shareholders are simply going to own more shares or they're going to own more equity in your company. And you journalize a stock dividend by debiting stock dividends, crediting stock dividends distributable instead of payable. It's stock dividends distributable. And then stock is transferred at market value, so whatever it's trading for. So there's likely going to be paid in capital in excess of par as well. And I'm going to show you an example of this right now. But basically, you should know that stock dividends only affect stockholders' equity, and we're simply transferring the amount from retained earnings to paid in capital. Okay, so a company with 100,000 authorized shares of $4 par common stock issued 40,000 shares at $8. Subsequently, the company declared a 2% stock dividend on a date when the market price was $11 per share. Journalize the entries to record the declaration of the dividend and the issuance of stock certificates. So, what this looks like. The first thing we do is determine the amount to be paid out. So that is going to be amount of stock dividend is equal to, so it tells us there's 100,000 authorized shares and then 40,000 issued shares. We care about the 40,000 issued shares because the 100,000 authorized shares, not all of those were even sold. So there's 40,000 shares issued, and they are paying out a 2% stock dividend, and this was on a date when the market price was $11 per share. So we already said that we issue them at market price, so the amount of the stock dividend is the 40,000 shares times the 2% stock dividend. So this itself is equal to 800 shares are being issued at $11 per share. And that is equal to $8,800 being paid in the stock dividend. So that is this number right here, all the way over here. So stock dividends, we are going to debit for $8,800, and that is the 40,000 issued shares times the 2% stock dividend times the $11 market price. Stock dividends distributable is credited for $3,200, and that is the 800 shares we're giving out times their value, which is the par value of $4. So that's the $3,200. And then paid in capital in excess of par is the $11 per share that these new stocks are issued at, minus the $4 par value times the 800 shares. And that is $5,600. So, first entry, this is the date of declaration, would be stock dividends are debited for $8,800, stock dividends distributable are credited for $3,200, and paid in capital in excess of par is credited for $5,600. Then you would have your date of record, which we don't journalize, and then we have the date of payment. So on the date of payment, we are actually issuing the stock certificates. So all we are doing is we are debiting stock dividends distributable to get rid of that liability. So we debit stock dividends distributable for $3,200, and we credit common stock for $3,200 because that is what we are paying out. Instead of it being cash, we are issuing common stock. So that is what is happening in this entry. Issuing common stock. And that is how you would journalize a stock dividend transaction. Next topic is stock splits. So a stock split is the process by which a corporation reduces the par or stated value of its common stock and issues a proportionate number of additional shares. So the goal is to reduce the par value or stated value by issuing a proportionate number of additional shares. And the major objective of a stock split is to reduce the market price per share of the stock. So we want a lower price per share. Why would you want this? An example is Amazon. So Amazon's stock is wildly expensive, and that's not accessible to the common investor. So they don't really have over $1,000 to shell out on a single share of stock. If you were to do a stock split, then it reduced the price per share, then it would be more accessible to more people. So the major objective is to reduce the market price per share. There is no journal entry for a stock split, so that's important to know. You don't journalize anything, it's just knowing the intuition of what's happening. So in this example, it says 10,000 shares of $100 par common stock outstanding, with a current market price of $120 per share, and then the board declares a 4-for-1 split. So we analyze its effect on these 3 different things: the number of shares, the par value, and the market price. The number of shares is originally 10,000, right? And the board declares a 4-for-1 split. So that means that for every share you have right now, you're now going to have 4. So if there were originally 10,000 shares, now there are going to be 10,000 times 4. So now there are going to be 40,000 shares because it's a 4-for-1 split. Whatever the number is, so like the blank for 1, you just multiply shares times that number, and that's the new amount of shares. So par value was originally $100, but that was when you had 1 share, and it was $100 par. Now you have 4 shares for every 1 share you had, so the par value is going to be split in 4. So 100 divided by 4, the par value is now $25. It's a $25 par stock because nothing is happening with the total equity. Before it was 10,000 shares times $100 par. Now it's 40,000 shares times $25 par. So the total amount is still the same. And then market price was originally $120. And we're going to assume that is also going to fall. So that was when you had 1 share and there were 10,000 shares. Now there are 40,000 shares and you have 4 shares. So this is going to be split in 4. So 120 divided by 4 is $30 for the price per share. So what happened? We went from 10,000 shares to 40,000 shares, $100 par to $25 par, and a $120 price to $30 price. So we achieved the objective of reducing market price per share. Okay, treasury stock is a little bit tricky. So treasury stock is stock that a corporation has issued and then reacquired. So anytime a corporation is reacquiring, that means treasury stock. And reasons can include providing shares for resale or bonuses to employees, or it can also be used to support the market price of the stock. So treasury stock reduces shares outstanding. So then when you're looking at numbers like earnings per share, total shares outstanding decrease, so earnings per share looks higher, and that supports the market price of the stock. Any sort of buyback is also usually a good sign, so treasury stock tends to support the market price of the stock. But basically you need to know that treasury stock is when a corporation issued stock but then reacquired it. Accounting for treasury stock. So treasury stock is debited, and it's debited for the purchase price of the stock. That's really important. It's not the par value. It's what you're purchasing it back at. And then cash is credited because you are reacquiring stock. You are buying it. So you, the company, are buying your own stock. When the stock is resold, so this is assuming you are reselling it, cash is debited because you're getting money, you're selling stock again for the purchase price. Treasury stock is credited at cost. So again, we're not using the par value, we're using the purchase price that we repurchased the stock at. And then any difference between the cost and selling price is debited or credited to paid in capital from sale of treasury stock. So there's a lot going on here, but I'm going to show you an example. Main thing is, in the first entry, when you're buying back and reacquiring the stock, treasury stock is debited and then cash is credited. When you're reselling it, cash is debited, treasury stock is credited, and then paid in capital from sale of treasury stock is credited. And we're using the cost, not the par value. Okay. So, in this example, it says we have 1,000 shares of common stock outstanding, and they were purchased by Corporation X for $45 per share. Corporation X then sells 500 shares for $50 per share. So, in the first entry, we are buying back the treasury stock. So, it says there were 1,000 shares outstanding, and we are purchasing them for $45 per share. So we are debiting treasury stock for $45,000, and that's the 1,000 shares times what we bought them at. And then we are crediting cash for that same amount because that's what we're paying to reacquire them. So this is reacquire. And then this is when we are now reselling. So, Corporation X then sells 500 shares for $50 per share. And a common question is like, why are we only selling 500? You don't have to sell any. So they repurchase 1,000, they're only selling 500. They may only ever sell 500. They might sell 500 now and then 100 a month from now. They could resell all 1,000 at once. It's totally their decision. It doesn't really matter. But what we do, we are debiting cash for $25,000. And what is that $25,000? That is the 500 shares we're selling times the selling price. So that is $50 per share. Treasury stock is credited for 500 shares, but times the $45 that we paid for those shares. So this is, again, we're using the cost, not the par value. We didn't even tell you the par value, and not what you're reselling it for. It's the 500 shares you're selling times the $45 price you bought it at. And then paid in capital from sale of treasury stock is going to be the price you are selling it at. So 50 minus 45, the price you bought it for, times 500 shares. So the resale entry is debit cash for $25,000, credit treasury stock for $22,500, and credit paid in capital from sale of treasury stock for $2,500. Okay, that covers the content. Now we're going to do practice problems. So, if ABC Company issues 1,000 shares of $6 par common stock for $50,000, what entry would we do? I always like to journalize it and then look at the options. So, we are issuing 1,000 shares of $6 par common stock for $50,000. The first thing we do is we know we're getting $50,000. So, you are debiting cash for $50,000. Then you are crediting common stock for the number of shares times the par value per share. So the number of shares is 1,000 shares times $6 par. So 1,000 times 6 is 6,000. And then we are crediting paid in capital in excess of par for the difference. So that would be $44,000. So then if we look at our options, it is going to be C. Paid in capital in excess of par will be credited for $44,000 because we are receiving $50,000 for stock that is worth $6,000. So the additional capital that we're getting is $44,000. Okay, this is a dividend problem, so it tells us Company X has 20,000 shares of $100 par, 2% cumulative preferred stock, and 100,000 shares of $45 par common stock. And the following amounts were distributed as dividends. Determine the dividends per share for preferred and common stock for year 1. So the first thing we do is determine the amount owed to preferred stockholders each year. And that is equal to, again, the number of shares, 20,000, times the par value per share of 100, times the dividend of 2%. And that is going to be equal to 40,000 per year. Okay, so then in year 1, we are paying out $10,000. So again, there's an issue. We are only paying out $10,000. We owe preferred shareholders $40,000, so they're going to get the full $10,000. So preferred is going to get $10,000 divided by the 20,000 shares, and that equals 50 cents per share. And common stockholders get nothing. So that is A. Obviously, if you wanted to keep going, then in year 2, you would have the $30,000, so this is for year 2, $30,000 div in arrears. Oops. From year 1, because they are owed $40,000, but they were only paid $10,000, and then they're owed $40,000 this year. So preferred stockholders are owed $70,000. They're only paying out $20,000 in dividends. So again, all $20,000 would go to the preferred shareholders. And you could continue this process. So again, if you'd like to do it out and check with me later, you are welcome to do so. But the answer for this question that it's asking about is year 1, so that's A. Which of the following is not true for a 3-for-1 split? So it says A, par value per share is reduced to 1/3 of what it was before the split. That is true. We know that par value in a 3-for-1 split would be new par is old par divided by 3. So this is true. Total contributed capital increases. That is not true, and we'll go over why that's not true in a second. For C, the market price will probably decrease. That is true. We know the whole objective of it is to reduce the market price. D, a stockholder with 10 shares before the split owns 30 shares after the split. We know that's true because new shares equals old shares times 3. So if they owned 10 before, then they own 30 afterwards. So B is the answer here. It is not true. We know that total contributed capital does not change. Because we're not issuing any new stock or anything, and I showed you in that example that total contributed capital stays the same when it was that 100,000 or 10,000 shares times $100 par, and then 40,000 shares times $25 par. Total contributed capital does not change in a stock split, and that's why we don't journalize it. Okay, and then 4, it says on June 1st, ABC Corporation had 50,000 shares of $10 par common stock issued and outstanding. All 50,000 shares had been issued in a prior period at $30 per share. On July 1st, ABC purchased 5,000 shares of Treasury Stock for $25 per share and later sold the Treasury shares on July for $20 per share on August 1st. The journal entry to record the purchase of the Treasury shares on July 1st would include. So we're going to journalize it out. On July 1st, we are purchasing shares. So we are going to be debiting Treasury Stock for the number of shares purchased times the purchase price. So it says on July 1st, we purchased 5,000 shares for $25 per share. So 5,000 times 25 is 125,000, and then we are paying cash for that. Because remember, when we're reacquiring stock, we are gaining stock back and we are paying out cash. So that's the first entry. That is reacquiring. And then on August 1st, we are selling it. And the question isn't asking for this, but I'm just going through it for your intuition. So on August 1st, we sold the shares, all of them, for $20 per share. So on August 1st, we are receiving cash, because we're making a sale, for the number of shares 5,000 times $20 per share, the selling price. So that is 100,000. We are going to credit Treasury Stock for the number of shares times what we originally bought it at. So that's the 5,000 shares times $25 per share. So that's 125. And here we have an instance of we bought the shares at $25, but we're selling them at $20, so we're making a loss. So we are going to be debiting paid in capital. So paid in cap is going to be debited for the $20 per share we're selling it at minus the $25,000, minus the $25 per share we bought it at, times the 5,000 shares. And that's technically a negative $25,000 to paid in capital, so that's why we're debiting it. So we debit paid in capital for $25,000. And that, again, is because we bought the shares for $25, but we're selling them for $20. So there's a reduction in paid in capital. So that would be the whole transaction, like what's happening. On July 1st, you buy the treasury stock by debiting treasury stock for $125,000, crediting cash for $125,000. On August 1st, when you sell all of it, you are debiting cash for $100,000, the $20 per share times 5,000. You debit paid in capital for the $25 minus $25 per share loss times the 5,000 shares, and then you credit treasury stock for $125,000, the 5,000 shares times the $25 per share you paid for it. What this question is asking for is the journal entry to record the purchase of shares on July 1st. So that is this entry right here. That answer should be B, debit to treasury stock for $125,000. Okay, so that is all I have for you. This is very long, but chapter 13 is probably the most detailed chapter. If you have any questions, as always, feel free to message me. Hope you have a great rest of your day.